Your trading strategy, it does not have to be complex. In fact, when you have too many moving parts in a strategy, or with anything really, it's pretty difficult to make adjustments. And when it comes to trading strategies, it's hard to test it. So if we break down what we're really looking for in a trading strategy, it's pretty simple. We are looking for the probability of one thing happening over another. Now, this 34 EMA trading strategy I'm going to talk about not only uses an exponential moving average, but it's also going to include trend lines. So what's the deal with trend lines? Trend lines are a pretty good tool, and they help you find the rhythm of the market. So when price begins to break from a trend line through the trend line, what we're actually seeing is a change in the rhythm and the balance of power. Now, I'm not going to talk about trend lines as a complete tutorial here. I got some videos here you could look at. But on the left, we have a downtrend trend line that connects the peaks of the price. So I call that the longer term trend line. You probably would call it that too. And it indicates the prevailing trend longer term. And the red one, it connects the final swing into the low. Because for my rules, I need to be able to connect the last swing into the lows or the highs. Now this line will probably break before the long-term one. And that puts me on alert of a potential change in the state of the market. A break above the red line is tentative longs. Break below, tentative shorts. And a break above or below the long-term line is a change of trend. And we would confirm that with price action. That's pretty much all you need to know about trend lines in the context that we're going to use them. Now, the 34 EMA, it's just a number. Okay, so I don't want you going down that moving average rabbit hole where you're looking for that best setting for the average. I'm just choosing a medium length moving average, and it's one that I use in another trading strategy, the CCI one. You can see in that video up here. Now you can see the slope shows a downtrend, uptrend, and a flat average will show a market that's in trend transition or a trading range. Now price will break above and below the moving average a few times. So that's probably not a way you'd want to use it to enter a trade. However, oftentimes traders are going to use a close above or below the moving average for trend direction. Now we can combine these two things, the trend lines and the 34 EMA. Now since we see that trend lines, they show a rhythm to the market. And when that rhythm finally breaks, we combine it with the average for trend direction, and we can use it as an entry trigger. It's the context that we're talking about. Same chart, both the trend lines and the 34 EMA. So let's break it down here. You put the exponential moving average on your chart, set it to 34. It's an EMA. Draw your relevant trend lines, ensuring that you have a longer term trend line and a shorter term trend line. So what we're looking for is we want to see a break of both the rhythm of the market and the trend direction. So once you have the trend lines and the EMA on your price chart, first thing we're going to do is look to see an early warning of a setup with a break of the shorter term trend line. At 2, price breaks above for a long, both the average and the longer term trend line. And 3, it doesn't matter which one comes first. So just looking at that chart, we can see on the left that price did break the moving average and close above it. Right, but that's not a long setup because we need both the average and the trend line to be violated on the close. As we go to the middle of the chart, we find our setup and our trigger rules are happening. Number 1, price breaks the short-term trend line to the upside. Now we're on alert for a potential long setup. 2, price breaks both the average and the trend line to the upside. Price closes above both. And you can either enter on a close at market or buy stop the high of that trigger candlestick. It's not the holy grail. It doesn't exist. Every single trading strategy you're going to lose with. And you could also miss some pretty big moves. But this is something you have to come to terms with before you ever put risk on in the market. And a great example of that is this future contract of sugar. This is the 1-hour chart. Sorry for all the lines here, but they're really needed to give you the proper perspective. That green circle is a break of the 34 EMA and closing above the shorter term downtrend line. The longer term trend line is actually broken long after prices cross the 34 EMA. So on this chart, you're going to learn a way to take profits as well as the setups that you probably want to avoid. So at number 1, after a 5% run up in price, we get a break of the trend line and the moving average on a closing basis. Now, that's a great place to exit the trade as A, we've put in a lower low, and B, price is broken our setup criteria. So why is this not an entry? A rule of thumb for traders is to wait for a pullback after a big momentum move in price. And you can see that one here. And sure, the market could keep on going and you might miss some moves, but it will prevent you from being in a position that snaps back on you. At 2, we are unable to draw a downtrend line at number 1 on this time frame using my rules. So I could not participate in this move. On a lower time frame, you might have been able to get an extra swing that you could use. Number 3, another momentum move breakdown, another setup to avoid because of the momentum move. Number 4, and you can't really see it on this chart, but price actually did close below the 34 EMA. But then price again rises with momentum and a long trade that we would skip. Okay, so the good lesson here is that whatever time frame you choose, it can make a difference on whether you're going to participate in the market or not. So a quick and dirty trading plan. Okay, now you got to do some work. So the first order of business is to focus on the risk component of these setups. And there are several ways you can set your stop loss. You can use the average true range. You can look for a swing high or a swing low to place your stop. You could use the low or the high of the candlestick that was the setup. You have to decide what you're comfortable with. And you can actually see the difference here using a swing level and the ATR stop loss location. Now, either one, it doesn't matter here. It wouldn't have even been tested in this particular trade. But we have to know when to take our profits. And just like the stop loss, it depends on you. You can use breaks of swing points on the chart. You can use the break of a trend line or a moving average. You can just keep it simple, and it's a multiple of your risk, or even use a trailing stop. Either of those or any of these, it's a viable way of taking your profits. That number 1, this is the break of a swing level. And as you follow the red line, you can see where your exit would have been. Number 2, this is actually a break of a longer term trend line. And number 3, it's a break of a trailing stop using the 34 EMA. And number 4, it's the break and a close under the EMA. Okay, I made sure to choose an example that's not perfect because it's way too easy to find one where everything just works out. Other things to note in your trading plan, are you going to discount using momentum style candlesticks, or will you just consider them they're actually showing a solid shift in market direction? How many positions are you going to carry? Will you re-enter a trade, or would you pyramid your positions? Okay, there's no wrong or right answer for these. And if you're considering taking additional trades, a simple technique is right here in this chart. All we're doing is playing trend line breaks in the direction of the 34 EMA. And one important factor to consider is whether you're going to use these shorter term trend lines as part of the setup for the main part of the strategy. Okay, so why that's important? Because there's going to be times when a break of the shorter term trend line occurs with the EMA and then would rally and give you an entry in the other direction, like we see here. Okay, the longer term trend direction is down. The red line is used for a shorter term trend, so I can use the swing high into the low to draw it. And as you can see by the green circle, this is a legitimate setup. Okay, price quickly reverses short again and would cause a quick stop out. Traders, you're going to lose, and there's no way to prevent that from happening. But if we can miss some losing trades so you can get set up with a longer term trend trade, why not do that? It depends on the trader. So to wrap it up, we're going to use 2 pretty popular methods of technical analysis: moving averages and trend lines. And you can take advantage of the main trend change when both the trend line and the EMA are broken with a close in either direction. You're going to have to decide if you're going to take additional setups. And to do so, you're going to have to adjust your criteria for a setup. And if you have knowledge of support and resistance and other price action methods, you will probably find these pretty useful in the strategy. Because as an example, we look back here at sugar. When that lower low was put in, this can actually lead to a trend change. But at the least, it shows that there was some weakness in this market. Okay, that may change your approach in trading during that particular time period on the chart. All right. Thanks for watching. Any questions, pop them below. And hit like, subscribe, and we'll talk to you soon.